Hello and welcome to the show. Today we're going to be talking about one of those companies in the power ecosystem, Genus Power, and plenty of moving parts here. We'll try and understand better as to what's playing out with regard to the company. You'll see how the stock price has moved. It's been extremely volatile in that sense. Flat returns over the 12-month period, but nonetheless, are things stabilizing? Is FY27 looking materially better? And most importantly, is the working capital situation likely to improve, as a result of which you could see better cash flows come through? We'll try and get a sense on how the operating cash flows evolve on a Genus Power. First off, let's try and understand what the company does. This was incorporated back in 1992, market cap currently at 10,000 crore, promoted by the Agarwal family, but most importantly, it operates in the power infra, smart electricity, gas and water metering business. All of these fast growing, all of these levers in terms of growth going forward, and a very large order book that this one sits on. Let me talk about the businesses first, and we'll split it into two verticals. One is the meter manufacturing business. That is one part of it. The other one is the AMISP business, which is basically a concession business, a concessionaire business, where Genus Power behaves or leases out its smart meters for a fixed annuity plus an O&M, and that business too is completely separate from the manufacturing business. We'll try and explain that to you very quickly. First one, with regard to smart electricity meters. One, it replaces the old manual read meters with communication devices. They measure consumption, of course, minute by minute, and they send data wirelessly. No meter reading technically required. It can be switched on or off remotely from a control center, and it supports prepaid billing as well, even though I have kept prepayment metering as a separate vertical of or separate product line, and that too does a very similar kind of a role where the customer prepays or ensures that there is already a balance within the device, like a mobile recharge, for example. The meter deducts consumption in real time, and the supply cuts automatically when credit turns off. So that's on the prepayment business. Then there's distribution transformer meters. These are nothing, they are not customer meters or consumer meters per se, but they are meters which are actually in the central or the area-wise meters, which kind of do a reconciliation of all of the consumption that's happened in the area versus what the meter reading in the area is. Any difference means that there's been theft. And this kind of basically ensures that there is low theft, or wherever there is theft, theft can be identified with regard to electricity. Now, that's one of the decent solutions out there in the market, given the fact that there are plenty of gaps and technical losses within the electricity infrastructure in India. The fourth piece is smart gas and water meters business. Now, this is basically household pipe gas consumption, and it measures the household pipe consumption as well as water consumption in households as well. It's one of the faster growing businesses globally as well, because there is a need for measurement, especially on the water side of things. Then there's the concession business, and concessionaire is nothing but it's an advanced meter infrastructure services provider. That is AMISP, which is the full form of it. Now, this is nothing but basically the lease on the meters that it manufactures. It houses those meters in one company, leases it out on long-term leases to the government or to various entities. And GIC platform or rather GIC, which is the Singapore company or the sovereign fund, has a stake in this particular business, 70+% stake in this particular business. And this is basically a recurring business which happens over long periods of time. There's going to be a scale up here as well as meters start getting dispatched and installed over the coming years. Own capital is invested upfront in meters, network software, EPC revenue, of course, during the installation, which is phase 1. Then there's a fixed monthly fee per year, which comes through for 8 to 9 years. Once operations go live, that is really the critical point in the business. That's the turning point. That's when the revenue starts to accrue. 74% of the platform is held by GIC. Genus Power holds 26% right now. The initial committed pipeline, of course, is $2 billion at this point. And the platform order book is at around 24,000 crore rupees. So that's one of the larger chunks of the order book of Genus Power as a whole. GIC pays the Genus EPC capex upfront once the operations go live, and it reduces Genus's working capital burden quite sharply. So this is a platform which Genus has built to ensure that they optimize their working capital and ensure that they focus on the meter manufacturing business without it impacting the concessionaire business. So that's the way to kind of think of this. But the other more important piece is only 26% of the platform, both in terms of profitability, accrues to Genus Power. The rest, 74%, goes to GIC. That's the critical element that you want to keep your eye out on. Now, then you've got various other technologies and softwares within the power ecosystem which Genus Power deals with. There's meter data management systems, which is MDMS, which is nothing but they basically dissect the data, validate, store, analyze the data which comes through from the meters. Loss analytics are looked at. Clean data is manufactured, engineered into billing systems and the like. Then there is head-end systems, which are nothing but central servers communicating with millions of meters simultaneously. That is also one of the important tech products which Genus Power does. And it's part of the entire ecosystem, right? So once you have a customer, you can sell various products to it. Then there's workforce management apps, assigns installation tasks to thousands of field technicians, tracks locations, and verifies each installation with a GPS tag as well. Then there's meter manufacturing for third parties. Now, this is a critical element. They do it for example, the Adani Group as well. This meter manufacturing is basically the supply of meters. Genus is the largest meter manufacturer in the country at this point. They manufacture, or they have a capacity to manufacture nearly 2 crore meters every year. So you've got a very large capacity there that Genus Power has, and they supply these meters to third parties wherever their concessionaire agreements don't require them to supply meters to the platform, which is the GIC platform which is there. Now, in terms of the financials, and you'll see some very, very strong growth numbers now come through. You look at the 3-year revenue CAGR, it's been extremely strong. You're currently sitting at 4,750 crore in terms of revenue. This will go to 6,000 crore very quickly, FY27. That's really the estimate. When you're looking at EBITDA, it's grown at a faster clip. You've seen margins get better as efficiency gains start to claw in. And you've seen that in the EBITDA number. And profitability is at 600 crore rupees currently. So you've seen very sharp growth in profitability as well. Why then is the business choppy? We'll come to that in just a minute, so stay with us. Margins, they've grown consistently better from 10% to 19%. 20% in fact come off from those highs. When you're looking at operational metrics in terms of order book as well, you have a very strong 5 times book to bill. Again, begs the question, why then is there choppiness in the stock price? And we'll come to that. And that is hidden in the balance sheet. What you're seeing is a book value of around 2,200 crore and obviously the market cap is 10,000 crores, so around 5 times book is what this trades at. This is book to bill, of course, but you look at the balance sheet now and you'll see the book to bill there. You'll look at the borrowing number, it's at around 2,300 crore currently. That's where one of the problems lies. You've seen how the borrowing has gone up from 600 to 2,300 crore. The revenue that's coming in is not translating, unfortunately, to cash profitability. That's where the problem lies. This is actually a thumbs down. If you can change that, that'll be great. But essentially, the borrowing number is a concern. Your debt to equity is more than 1:1. But of course, you've got cash sitting in the balance sheet, around 720 crore rupees of cash, which is sitting in the balance sheet. Before I come to cash flow, let's look at the balance sheet first. And within the balance sheet, cash bank balance is around 720 crore rupees. So you are sitting on a net debt of roughly 1,500 crore rupees. That is still large in relative terms. When you're looking at the cash flow is actually negative. This is the cash flow which is in front of you. Negative 203 crore is the cash flow from operations. 913 crore is the EBITDA. And therefore, what you're seeing is cash flow from operations to EBITDA being severely negative. And as a result of that, you're seeing also a negative net cash flow from operations, which is at 465 crore negative. So on all of those counts, it's looking weak from a balance sheet and a cash flow perspective, which is why this doesn't get the multiple that it ought to. When you're looking at return ratios are north of 20% currently, so very strong in terms of the return ratios, no concerns there. In fact, it's gone above 19% in FY25 and thereafter at 24% FY26. So no concerns on the return ratios, but if cash doesn't come in, then it's a problem. And that's what they really need to repair. Let's look at shareholding pattern. In fact, the shareholding pattern, the promoters have continuously divested. FY23, the promoter shareholding was at 50.5%, currently at 39%. And then on top of this, there is a promoter pledge of around 5% on the current holding as well. So out of 39, 5% is pledged. So effectively net of pledge around 34% is the promoter holding. You've got FIs, DIs holding around 19 and 3% respectively. And then you've got the public holding 38% in Genus Power. When you're looking at valuations, that's the other concern with regard to shareholding, because promoters have reduced shareholding. When you're looking at the current valuations, they're currently trading at around 14 times earnings. The 5-year average is at 29 times, and the range is massive, right? Around 4 times to 66 times. Given cash flows and everything that's played out with regard to the company, also there are a couple of risks with regard to allegations of possible malpractices within bidding process, which is also underway. There is some contingent liabilities as well sitting in the balance sheet, which is a concern, which is why you're seeing the kind of fluctuation in the valuations that you are on your screen. In terms of analyst recommendations, there are 2 buy calls, 1 hold call with a 36% upside. Only reason why we have given this a neutral is because there are very, very few analysts covering this one. Okay, so that's something to kind of contextualize. Let me bring on board Mr. Jitendra Kumar Agarwal, who's Joint Managing Director at Genus Power, joining us to give us a perspective on what lies ahead, sir, for the company. Let me first start off with raw material prices, Mr. Agarwal. So, one of the concerns is that your contracts are fixed cost, and raw material prices have gone up significantly. I mean, from power costs, of course, which is not technically raw material, but even your other raw material prices have gone up. How are you insulating yourself? And if not, what's the impact on margins for you FY27?
Yeah, hi. Good afternoon. So I have given the guidance already that this year we are giving a guidance of 18%. And the reason has been the raw material cost. In general, if you see, our raw material is not a very high percentage. There's a lot of value addition in terms of technology. So this is not a business which is very high on BOM. Our BOMs ranges from 55 to 65%. So that is why we are giving still, these are fixed term contracts. So we are giving a 2% reduction in the EBITDA for this year. Our guidance is 18%. And we are more than confident that we will be able to achieve this 18%.
Okay, so confident of that 18%. Talk to us about execution, sir. You're sitting on a very large order book. How does execution start to play out? Do you do 6,500 crore of top line? And is it linearly spaced across the year, or will Q1 be slightly difficult in terms of execution, and will Q4 be stronger? How does it progress?
If you see the electricity business overall, always the Q1 and Q2 will be lesser than Q3 and Q4. You have to understand, we are dealing with the consumers directly. Distribution business, especially the summer season, April, May, June, then the rainy season, July, August, September, will always have less installation. This has been the history from last 2 decades. So I don't see that history is going to get changed. Quarter 3 and 4 are definitely going to be better than 1 and 2. But yes, it won't be a major difference. It will be quite linear, but 3 and 4 will be better.
Understood. And with regard to concerns on the cash flow front, so I think that is the crucial concern which the street has. Does that reverse in H1? Does it reverse in H2?
So you will see you have to understand the business model. We are not stopping the installation. It takes its own time initially to start the project. It takes minimum 9 to 12 months. And for first 12 months, practically the Genus Power is investing in the manufacturing of meters, installation of meters, doing the OGL. Everything is done by Genus Power. So that is why you will see a lot of cash being invested. But once the OGL is done and the meters comes into the regular set process, and once the regular process starts, it takes 12 to 14 months, then you will see a significant reduction in the cash flow. And you will see the number of meters being installed in the last 6 months has gone up significantly. That is why a lot of cash has been pumped in. We are dealing with electricity boards, and we have never faced any problem in the sense that there is a problem of getting money from the electricity boards. And these are very insulated projects where the electricity board is very, very well opening the DDF accounts. The whole money is flowing automatically. There's no much role from the utilities in terms of giving payments to the AMISPs. So it is just a matter of time. And since we are growing the number of installations, you will see cash flow getting positive from next financial year, and it will reduce significantly to a right side in this financial year. So all your cash flow controls, you will start seeing getting them better every day.
You're saying that in the current financial year as well, you'll likely do a negative operating cash flow. It's FY28 when cash flow starts to turn positive. Understood.
Absolutely.
And with regard to the quantum, there was a sharp negative, I think negative 200 crore in terms of operating cash flow in FY26. Where do you stand where FY27 is concerned? How do you see that journey? That's point number one. Point number two, the platform business, which is your AMISP business, which you do with GIC, you just have a 26% stake in that. How much of the cash flow or how much of the impact actually translates to your business? I'm trying to understand that.
So you have to understand this model with the GIC. The platform is created to do the AMISP business. The AMISP business is that initially all the investment is done by Genus Power in terms of manufacturing meters, doing the installation, and once the OGL is done, the electricity board pays to the platform in 93 equal months. But platform pays to Genus as a capex. So it's a beautiful model in which is the whole EPC business is done by them, not the EPC, the whole operational business, everything is done by Genus, from meter manufacturing to installation. So what you have to understand, this platform, which is owned 74% by GIC and 26% by Genus. GIC is primarily a financial partner and Genus is an operational partner with 26% stake in the platform. So everything is done by Genus, from manufacturing of meters to maintaining meters for 93 months. GIC pays Genus as a capex, where GIC platform is paid as a OPEX. So it's a beautiful model being created, and once you will see more and more meters being installed and coming into OGL. Just to give you a ballpark number, as on date, Genus has installed more than 1.3 crore meters. But as when you see that SAT and OGL, it is only 80 lakh meters that has come into OGL SAT. That is why you see a lot of cash being invested by the company. Once this 40-50 lakhs gap between the installation and the OGL is going to get closer and closer every day, it will only get improved every day. You will see the cash flow situation improving significantly because we get paid exclusively from the platform with immediate effect. So that is where the whole model is.
I understand. How quickly do these get installed? Talk to us about the number of meters that get installed in FY27 expected.
So we expect to install at least 1 crore meters this financial year.
Okay. And your production capacity is at what? 1.8 crore meters?
Just to give you a number, last year we produced around 1.75 crore meters. So all kind of meters put together, we can easily produce from 1.8 to 2 crore meters. You have to understand one business model of Genus. Genus is not only supplying meters to its own concessions. Genus is the largest manufacturer for the overall market also. So whether all the utilities who are buying directly smart meters or normal meters or all the AMISPs like Adani, they are all our customers. So we supply meters to them.
Okay. What would one think of with regard to debt? Because that's the other concern for investors in Genus Power. how should one see debt profile evolve over the next couple of years?
So you have always, if you see the last 5 years of Genus or last 10 years of Genus, as a promoter, we are very conservative and always been a net debt-free company. Because of this growth, this debt has been taken, but very systematically, this debt has been taken. And currently, we are standing at around 1,500 crores. Maximum, it will go up to 2,400 crores on net debt. But here, from next financial year onwards, you will see this reducing significantly. Once you will see these projects going live and we start getting paid systematically from the platform, all this debt is a matter of time. 12 to 14 months, you will see debts going down significantly.
So you're saying the debt will first go up to 2,400 crore, then
Yeah,
come
that
off.
is the maximum limit, I believe, yes.
Understood. Okay, last question. Can you do 6,500 crore of top line this year? And how much of that will be O&M? How much of that will be meter sale revenue?
So right now, the O&M revenue is very limited. You will see
Correct.
significant or realistic, the real, what I call it, the right numbers or good numbers of O&M coming from after 2 financial years. Primarily, it is going to be meter supply and the meter supply to the concessions. And 6,000, we have given a guidance of 6,000 to 6,500. I'm 100% confident that we'll.
Okay, Mr. Agarwal, can you quantify the number in terms of O&M 2 years down, FY28?
So 2 years down the line, I see O&M revenue comfortably coming to 600 to 700 crores. In
Okay,
next
so understood. So maybe 8 to 9% of your top line at that point of time.
At that point of time, and you have to understand this from the current order book. So currently, Genus is doing around 3.5 crore meters as a smart meters. And there is a almost 50% meter market is still available for us to address. So definitely, if you see 4 or 5 years down the line, Genus O&M business reaching 1,100, 1,200 crores is definitely a possibility.
Okay. Okay. Gives us a good perspective. Thank you so much, Mr. Agarwal, for coming in and speaking to us. Pleasure speaking.
Thank you. Thank you.
Viewers, completely timed out on this edition of All About Your Company. Thanks so much for tuning in. More action to follow. Stay with us here on ET Now.